So we hope that you will join me in welcoming Mark for the first part of our program.
All right, step one, I got the microphone to work. All right, so let me get situated here. Okay, so our job here today, as part of this day of fun and exciting activities, is we're going to learn a little bit about investing in our institutions. How do we make them stronger? We're going to be faced with decisions about investment. We're going to find out who decision makers are on your campus, how we might be involved in those decision-making processes, and what resources we might have available to us to make those things happen. But as CFOs, we work in a world every day where we take these things for granted. We assume that everybody knows what's going on when we talk about net tuition revenue or expendable resources or reserves or spending policy. Those are words that sort of roll off our tongue and we assume everybody knows what we're talking about. But today, our job is to really start with sort of the fundamentals, the building blocks, so that everybody in the same room is at the same sort of place. And you'll be working on a case study later today that hopefully after what you hear through my remarks and Jackie's remarks, you'll at least all be sort of on the same page and be able to speak in the same tongue as we go through sort of the highlight of the day, which I like to think is this, but is probably the case study work. So this is terminology. I'm not really going to walk through all of this terminology. My job really here today is to sort of interject these comments. I'll try and do a better job of defining them as we go through the presentation. These are really here more for a reference. A reference after today, I'm sure you're all going to keep this close, under your pillow, close by. Take a look, refer to these things, but more importantly, perhaps during your case study. When you're doing your case study work, this might be a good time to reflect on the terminology here. So this can't be exciting. We're talking about finance, first thing in the morning. Everybody take a sip of coffee. I'm going to go out on a limb here. And assume that by a show of hands, anybody watch the HBO series Hard Knocks? Anyone know what that is? Not one hand in the room. All right, well, then we're out on a limb here. You're going to have to join me. So Hard Knocks is a HBO series that is following the Oakland Raiders through their training camp. And it goes through, it's a weekly series, and every week it goes by, and it builds up, and it sort of ends with as the new season starts. And John Gruden, anyone who follows the NFL, he's kind of like a crazy coach, and you learn a lot. He's a very animated guy. And one of the things that he does in his team meetings to sort of keep the attention of the room to make sure no one's dozing off, he gives the old knock if you're with me. So throughout this presentation, I'm going to make sure you're paying attention. So as we go through this presentation, I'm going to say, knock if you're with me. So I want everybody to knock on their table just to make sure that you're with me. So it's kind of cool. So I'm going to call for it throughout this presentation. So if you're not paying attention, I'm going to know. So knock if you're with me. All right, good. Thank you. Knock if you're with me. All right, terminology, framework. Again, I talked about this a little bit before in my opening remarks. This is kind of why we're here. This is sort of a outstanding graphic that I wish I could take credit for. I had nothing to do with the construction of this, but when Diane and Katie put this together for me, I thought this really does a great job of, in sort of pictorial form, demonstrate what we're trying to do here today. So on the left side of the chart, the gears, that's kind of our everyday operations. These are the things we know. These are the things that are kind of in our wheelhouse. We'll talk about that in a little bit, but that's kind of like the churn of our day-to-day operations and what we do. We're going to talk a little bit about that so we have a better understanding of that. So we're going to learn about that piece. On the right-hand side, we want to talk a little bit about investment resources because our day today is really about finding out how do we do new things? Who do we talk to? How do we get involved in doing new things? And if our day-to-day stuff doesn't really give us an opportunity to do those things, how does it get done? So we're going to talk about the resources that are available in that regard. And then we'll talk a little bit about how do we spend it? What are the things we sort of spend those funds on? So I don't need to spend a lot of time on this. This is what we call our operating activities. This is our day-to-day stuff. This is students in the classroom. This is educating them. This is research. The football team on the football field, research that's going on, student life, counseling, all the things that are just kind of our I don't want to say it's our mundane things, but it's our core competency. It's kind of what we do just to sort of keep things rolling along. That should not require too much further explanation. But within that, we said there's operating revenues and operating expenses. So any general observations when you just sort of look at the chart, what's the first thing that sort of grabs your eye? The reliance on tuition and fees. Very good, Bob. Knock if you're with Bob. So yes, tuition and fees. So 77% of our revenues, and again, this is generally speaking, a lot of this information was taken from the 990s of our institutions. So it's a fairly representative of all of us. I will say, and I should have mentioned this sort of earlier, as we go through these remarks, sometimes you're tempted to say, not us. We're really not like Moravian, or we're really not like DeSales in that regard. I would ask you, generally speaking, all these comments apply to all of us. So some might have an extra comma, but the reality is that the general concept is representative and reflective of all of us. So yeah, tuition and fees represent such a huge percentage of what makes our operating budget run. So not surprisingly, institutions spend a lot of money in this area. They spend money on consultants. Most enrollment departments probably have some sort of data analytics. If you're not doing it yourself, you're paying someone to do it. It's a very sophisticated science that we invest in. Why? Because almost 3/4 or more than 3/4 of what it takes to get our jobs done comes from it. So we're very dependent on it. So institutions spend a lot of time on it. So I thought we'd spend a little time on it here today. So tuition and fees. The term I have up there is net tuition revenue, or NTR. Sticker price is what we hear. That's what grabs the headlines. That's everything you read in the newspaper. They talk about the high costs of college education, and you'll hear $40,000, $50,000, $60,000 for tuition alone. While all of that is true, for the bean counters in the room, we know that is a facade. That is not reality. That is not what students pay. So I thought first I would walk through just sort of the fundamentals of discounting and financial aid, just so you have an understanding of when we say NTR, net tuition revenue. That's a buzzword that, it's creeping out of the accounting world, I think, into others, so you may have already heard about it. But net tuition revenue essentially represents the sticker price less the financial aid that is awarded to students. Now, financial aid that gets awarded to students comes in two forms. It's either funded or it's not funded. And we like to think that a lot of it is funded. We hear about endowment, and we hear about endowed scholarships. And the reality is, and I'll walk through this in a moment with an example, it takes a lot of endowment to fund financial aid. So the reality is, we just discount. And this has been a dirty word. We'll let you in on the first accounting dirty word, tuition discounting, because no one likes to talk about it. They don't like to say those words. We like to say presidential scholarship, the president's fund, whatever it is you call it. We put beautiful names on it and make parents and students feel really great about it. But the reality is, it's basically just lowering our tuition. It's not funded. It's just money that's not coming in the door. I'll digress a little bit with an example and why we do this, because I talked before about the amount of money we invest in consultants in enrollment management. And if we know, by way of a quick example, if you charge $40,000 for tuition and your discount rate is 60%, and that sounds crazy, but it's not. For some schools that are in the room, it's a little bit lower than that, but for others, that's a harsh reality. We are bumping up against that. So at a $40,000 tuition sticker price and a 60% discount rate, do the math. That's $24,000 in financial aid with a net tuition revenue of $16,000. $16,000 available for resources. So if you think about it, that's $24,000 in scholarship. Now I'm going to jump ahead a little bit. I'll explain this in more detail later. But when we talk about endowed aid, it takes, if someone gives $1 million endowment to support a scholarship, most spending policies, the amount that you're allowed to take off of that is between 4 and 5%. So at $1 million, let's call it 4.5%. That's not a whole lot of money on $1 million worth of scholarship to fund, to create funded aid. So the reality is it's discounts. So my example is, when you walk into a store and there's a table with shirts on it, and there's a table that has shirts listed for $100, on sale, 60% off, price $40. And then the other table, there's a table of shirts that says shirts, $40. Which shirt are you going to buy? Are you going to buy the one that's $100 on sale and it's cost you $40, or are you going to buy the one that's $40 full price? Don't tell me who's going to buy the one that's $40 full price. I'm going to call you a liar. Exactly. That reality holds true in higher education. So when we talked before about our consultants, there's a huge debate about whether to, if I'm only collecting $16,000 in net tuition revenue, why not just charge $16,000? It seems silly. It's like a game. But unfortunately, the American psychology of I'm getting a value, or my son got a discount. Man, my kid is smart. They got the presidential scholarship. Or oftentimes in Division III, we hear my kid's getting $12,000 to play baseball. No, he's not. He's really not. But if that makes you feel good, go for it. But that the reality is there's a whole science about that high tuition, high discount versus net tuition. Some schools are trying it. Elizabethtown this past year went through a tuition reset. We have not found too many schools who have found a lot of success with that. And I think more and more are getting, there's more and more test cases out there, and I think more and more people getting nervous about it. But the reality is, for the purposes of this room, I've probably told you more than you need to know, a lot of interesting information. But the reality is, tuition, it is a huge component of what we need to fund our operations, and it's getting squeezed further and further. The reality is, when we talk about tuition, I think I've got this in a later slide, but when we talk about tuition and the squeeze that's going on with pricing, we haven't even talked about the demographic. We haven't even talked about that there's fewer students out there. That was a session from earlier in the year. So we're just talking about it. If nothing changed, if we had the same number of students, the competitive that's out there for existing students, and then the student body is shrinking, or the number of graduating seniors is shrinking. All right, where am I? So, you know what, I wanted to mention this. When we talk about mandatory fees, I threw that in there only because oftentimes when we look at analysis, and you probably will not get to this granular level of detail in your discussions, but mandatory fees, while they look good in sort of your gross revenue when you talk about, hey, we've got all this money in tuition and fees, the reality is that fee money is not available for you to spend, because it's already been earmarked. In our case, we charge it for the USG, our student government, or for safety. And that money, if the student comes and pays that fee, we scrape it right off the top and put it over, and it's not available for general operations. So if the student doesn't come and the student doesn't pay it, we don't have it available. So that's why I wanted to include that little blurb. So this chart is, it's a good chart. I prefer a different one, but let me explain this one, and maybe you can visualize the type that I like. If you can look for a moment, don't focus on the orange. The orange the chart here is comparing the gross price to the net price. So the gross is the solid, the dashed is the hatched. Orange includes room and board, blue is just tuition only. So I want you to focus on just the blue. So you can see there's always been a gap, that much we know. But clearly over the last 10 years, 20 years, that gap continues to widen. At many schools, what we're seeing is the gross tuition price is going up, and the net tuition price is beginning to break and go down. It's always been a gap where they've both been going up, and you can see in this chart where it's sort of leveled off, but I'm telling you, there are schools where that is starting to crack and it's going the other way. The chart that I prefer to look at for this demographic is a bar chart. So ask your CFOs, don't tell them I sent you, but put together a chart that shows the gross tuition price over the last 10 years and the net tuition revenue received right next to it. and you'll see the bigger bar going, and you're going to see that smaller bar level off and potentially breaking downward. It's a scary trend.
Mark, you can definitely tell the difference, though, with the recession. It really seems to be the inflection point. Before the recession happened, it was a little narrower, and people had more resources available. Maybe
Right.
it wasn't the right thing. They were tapping into their houses, maybe more home equity to pay bills, and definitely a change in attitude.
So Bob's point, well taken. In the 07, 08 era, that was the game changer. I think that's when people really got, oh my God, what is going on? Concerned about finances. Can I really afford to do this? And that was when the conversations in the enrollment, anyone from enrollment in here? Right. So you know what the conversations you hear. Hey, Susquehanna gave me this. Here's their offer. Can you match it? It's like shopping at Walmart. And it's sickening, but that's what the mentality that has come upon us. And I think you're right, Bob. I think that all started when economic pressure started to hit the individual families. So knock if you're with me because the 990 reports financial aid as an expense, not a net of revenue. So it makes it a little bit misleading. So when I look at this chart and the composition of our expenses, grants essentially represents financial aid for all intents and purposes. So that's an expense, not a net of revenue. So the reality is if you sort of realign this chart with that line out, what's going to pop up is your compensation is a much, much larger percentage of your expenses. So as we look at all these things in here, this might not be, as I look at these lists of expenses, I try to see, okay, if in trouble, if our net tuition revenue isn't what we expected it to be, and I've got to cut some expenses, where do I go? What's our, quote, discretionary spending? And if you sort of work your way around the wheel here, depreciation, debt service, you can't cut that. That's fixed. Those things are already purchased or already borrowed. So no skin there. The grants, even in the representation of this chart, if we've said financial aid is critical to bringing in our most important resource, which is tuition revenue, that's not discretionary. And in most cases, enrollment divisions are asking for more money in that area. We're down to our people. And if you look at what's sort of an occupancy, which again, those are the costs of operating your buildings. You typically find maintenance contracts, repairs, things that I would not like to think as discretionary. So you're down to other expenses and supplies. And what we often tell folks when someone says, well, just cut 10% out of your budget. You got 10%, that's about all you got left after the things that you're already sort of committed to. Your discretionary spending within your operating budget is not as much as you think. You say, oh, we got $70 million to work with. Easy. Well, when you start, if you don't want to cut people and you back out the things that you can't cut that you're already committed to, the challenge gets a little bit more difficult. So have I depressed you all good yet? All depression? Trust me, we'll be smiling by the end of this, and not because it's over. So again, within the compensation piece, don't need to spend a whole lot of time on this. This is just a reminder. When you think about salaries, this is a common mistake when you're evaluating your case studies later today, anytime things that might require a new position. Oftentimes you say, oh, we can fill that position for $65,000. Don't forget, you got to gross it up for taxes and benefits because those are often overlooked. And if you're talking about faculty lines, think about things like startup expenses, computer, office furniture, all these things that sort of sneak up on you that you don't necessarily think about when you're hiring a new person. So again, I know in your case study, those are things that you're going to contemplate. Keep this in mind. It's not just their salary. There's all those other things that come with hiring that person. So now that we're depressed, and I've explained to you that really that left side of what we were going through today, that our operations, there is just not a lot of wiggle room. We've talked about our tuition revenue, that is essentially the core of what drives that left side of the chart, and that part of our institution is being squeezed hard. So we can't necessarily expect that the left side of this chart here, our operations, is going to be spitting off millions of dollars for future investment. In the world of corporate America, that's the way it works. You make money, you make a profit, and then you take those earnings and you reinvest them to make more money. That's the model. That doesn't work here. If we're doing our jobs right, we'll have a little bit of surplus, but the reality is we are nonprofit institutions. And we generally, we all know, we operate on the margin. So at the end of our year, we typically have a couple nickels that we rub together and don't have a whole lot for reinvestment. So what do we do? What do we do? Well, that's why I want to talk a little bit on the left-hand or on the right-hand side of our chart. Investment resources. There are opportunities to get things done. So ways we can increase resources to create investment. Now, investment resources is not like a gap term or you're not going to find that in an accounting manual. That was sort of my 2 words that I put together for the purposes of this group, knowing where we're headed with our conversation. This is the resources that we have available for future investment. What are they? So donor gifts. I'm sure we all know, we can think of the easy ones where you've got someone who's got a passion for sports and they're the football team and they want the football team to get new blocking sleds. So they give us $10,000 and we go out and buy new blocking sleds. Those are the easy ones. So we can get things done in that regard. We had a recent example with our field house where our field house was just awful. And the football locker rooms or the football lockers were just not in good shape. Well, that's something that our athletic director knew would resonate. You get together the football alums, and in no time you have enough money to get a project done, and you can just go out and solicit those gifts, get them, and get the project done, and it's a great thing. Unrestricted. The example I wanted to give you here is oftentimes we are named in someone's will. So when that person matures with a capital M, and we are named in their will, those are sometimes they're restricted, but sometimes they're not. Sometimes it just says to the good of the college. And we can take those funds and set them aside, and when a need arises or when we want to start a new program and we've got an opportunity to do something new and exciting, those resources are available for us. So again, the point is they come upon us without necessarily solicitation when we receive the funds. We just solicited them years ago before the person had died. Endowment. I'll talk a little bit more about endowment. I believe I've got another chart on this. Endowment is funny. It's a great thing. It's how we, in many ways, measure our success. And we spend a lot of resources managing it, investing it. Oftentimes it's 70, 80, 100 million, $1 billion. So clearly it's a very important part of our fabric as an institution. But the reality is, you heard my example before, it takes a lot of endowment gift to have a significant impact on some of the things we're going to talk about today, which is kind of like I need 50 grand or 200 grand. That takes a lot of fundraising and endowment to make that happen. So it's a great thing, and we talk about it. We always have to do it. But the reality is it's hard to make a real impact in that area. With that said, let me just quickly flip to another chart. I'll come back to the previous. This is a chart that Diane had found about when people give to endowment, what do they give it to? Not surprisingly, scholarship is amongst the highest, almost half of what people like to give to. That shouldn't surprise anybody. The good news for us, as what I mentioned to you before, the biggest squeeze we have is in financial aid. So the reality is, if this is something that resonates with people, the more that we can flip that, I mentioned there's funded aid and unfunded. For every dollar we create in funded aid in this endowment, that's one less dollar that we have to sort of discount and just lower our sticker price. It's real money that we've earned. So again, just wanted to point that out, that endowment can help, and it can help in offsetting an expense that we're incurring in financial aid. So spending policy, I mentioned that already. I won't go over it again. The reality is most institutions have a spending policy rate between 4 and 5%. Ours is 4.5%. It's been that forever. So at the end, we value our endowment. It's a rolling average over the last 12 quarters. The value of that endowment times 4.5%. That is what comes in to support our operating budget. So just know that is an income stream that is part of our budget. But for those who do budgets in this room, know you depend on that. That's part of what you're already depending on. So again, it's not as though that's incremental. Our budgets, at least ours does, depends on that spending policy to support our basic operations. Grants. So I would encourage you all who are in F&A to have a close relationship with your grant writers. So we just hired a new director of facilities, and within the first few weeks, our director of facilities was in the office of the grants writer to say, hey, look, here's a list of projects we know we need to get done, and we think that there's foundations out there that support this. So think of things like, well, for us, historical buildings. There are foundations that really love historical buildings and capital improvements. There are foundations that really love sustainability. So look for those foundations that can support if you've got a project you want to get done. There are specific things out there that you can get done, and you can solicit foundations or private donors for something that might or private foundations rather, that can support what it is you want to get done. So don't forget about grant writing. I had to include savings from operations, but as I said to you before, that doesn't happen a whole lot. At the end of the day, our bottom lines are generally pretty flat. And I will mention with one exception. And again, I don't want to say this is a dirty little secret, but it's a way that we have surpluses that we don't necessarily think of. So most of us, when we have line items in our budget, let's call it energy. Energy can fluctuate from year to year. You can have a cold winter. You can have a very mild winter. Most institutions will budget an amount, and to the extent they come in above or below that, let's just say they come in under it. So our budget was $1.5 million. It was a warm winter, and our energy consumption came in at $1.2 million. So we have $300,000 left over. So that is that's a surplus. I mean, we've actually performed $300,000 better than what we had planned on. The reality is, what we do to consume that surplus is charge my energy budget for $300,000 and consume it and put it in the word is reserve. We put it in a reserve, or we designate it. And the reality is it's an operating surplus that we realized, but I've earmarked it saying I can't spend that on anything else because I know next year we could have a terrible winter and I need that money for when I only budgeted $1.5 million and I come in at $1.8 million. So I mention that only because we are often say, hey, we had a really warm winter. We should have extra money. Well, yeah, we do, but I'm planning for the really cold winter. So it's an operating surplus that kind of got consumed. So you'll see in that terminology, I have a word out there called reserves, and that's what I'm speaking about. I'm talking about times when you've actually performed better than you had expected in a particular line item, but it's a risk area. Legal is another one, or if you've got a reserve for deductibles on your insurance. Sometimes you have really, really bad years in insurance claims, and you've got a lot of those deductibles. So we kind of keep those, we fund them at a flat amount, and when we do better than expected, we park some away. And good old-fashioned borrowing. So borrowing is great, and it's great on one day when you're sitting with a big pile of cash that you just got from the bank. But it's that whole paying it back thing, and that's the reality when you get into your discussions later today. Borrowing, and it is so tempting. It is so tempting, and it's easy, and money is cheap right now. You'll oftentimes people hear say that interest rates are at all-time lows. We should be borrow. Right. So that's while the amount of interest we're paying back is low, but the principle's the same. Though that doesn't change. So the reality is, we've got to be aware of that. It is a resource. People do it all the time. We do it. When projects come up that aren't necessarily sexy for fundraising, those are the things you got to borrow for. So, we've got a significant enhancement that's required in our boiler room. You're not going to find a donor gets excited about a boiler room. That's going to be, more than likely borrowed when it's an expense that's in excess of $1 million. The decrease. How many time? All right, we've got plenty of time, so feel free to ask questions. Knock if you're with me. I see some nodding. All right, sorry. All right, so the decreases of available resources. I won't spend a whole lot of time on this, just two of them, because a lot of them are kind of baked into what I'll call strategic investment, and we'll talk about them in that context. The two that I did want to talk about were annual spending rate again, we've talked about that. That's the accumulation of your endowment. But every time you spend out of your endowment through your spending rate, it is decreasing that value. Now, the expectation is that through, good investments, you make more than you spend. So there's a chart here that I wanted to share with you. Now, this chart's a little bit misleading in that the solid bar across the top represents what we as institutions expect our return to be. It's our expected return. Most colleges have it in the 7 to 7.5 range. So the way we invest in our endowment between equities, more aggressive investments and more conservative investments, we have an expected return of between 7 and 7.5%. Why do we do that? Because we know we're going to spend 4.5% of it or 4 to 5% of it. Plus, we also want to cover inflation. So what you see there is a sort of a combination of 4 to 5% spending policy and another 3% or so of inflation. Now, inflation's been running a little lower than that, so you're seeing those actual returns coming in below. Those are 10-year returns. They're coming in underneath the bar, but the reality is that the top bar is probably a little high because inflation's been a little bit lower than what's in those assumptions. And then the last one was operating deficits. So I spoke about that a little bit in my energy example. So again, that's an example where you had a surplus. Your surplus fell to the bottom line, or you reserved it, and then the year when you had your bad energy year, you actually used that reserve. That's using up that excess surplus. So just know that those good performances can go both ways. It can provide opportunity, and it can provide a risk. One thing I will say is, and your CFOs are doing this, I'm sure, they keep their eye on those reserves, because oftentimes, if they're accumulating to a level where you can use them and you're sort of over-reserved, one of the dangers you don't want to have is that you're cutting yourself so thin on your operations and cutting budgets, perhaps cutting positions, and sitting with this big fat reserve that you're never going to use. That's not a good place to be in either. I would tell you, as you contemplate your case studies and you look at the types of expenses that you're going to be thinking about, if you've come across a situation where you say, hey, maybe we've got a heavy reserve that we can use, try to limit them to one-time spending. So a one-time spending is a bus or going to a conference or something like that, as opposed to hiring a person, because those reserves are going to go down and eventually run out. And unless you're planning on getting rid of that person when the reserve runs out, that's not a place you want to go. All right, we covered that. All right, strategic expenditures. So we talked a little bit again about the tightness on the left-hand side. We've talked about opportunities to create investment opportunities on the right-hand side. What are some of the things that we might spend these things on? So again, your case studies are going to talk about some of these things. You're going to talk about creation of future, starting a new academic program. I think that's one of the things that you're contemplating. Creating a new sports team, constructing a new building. Again, we're going to talk a little bit later about sort of the interdependencies of this stuff. But remember, oftentimes when you're talking about starting these new activities, don't forget about the fact that those things, they're going to move from that right side of the graphic that we've been going through to the left side. So you might have startup funds to get them started, but don't forget you're going to have to sustain them once they come into your normal operations. So those are, again, things that you might want to consider or do. We just constructed a new health science building. So we fundraised for a bunch of it. We borrowed for a bunch of it. We put all of that debt service in the building. So we got ourselves, the building built and constructed. Thankfully, we remembered things like, we're going to need custodians in there. We're going to have to pay custodial to clean it. We've got maintenance contracts and all the fire extinguishers in there. We've got filters in all the HVAC units that we're going to have to replace. All these things. We've got extra walks that we're going to have to clear. It's all the sort of the operational things. Like, you got to remember to think beyond the obvious and think of in your sort of normal operations, these things are going to hit us in ways that don't always come to mind or not always top of mind. One of the questions that one of our trustees asked us, if you're following Moravian College, we have built quite a few buildings lately. We put a lot of new things within the footprint of our campus. And one of our trustees said, what are you doing to cover the deferred maintenance on all of those buildings? So, everyone knows that when you build your building, the first day it's in service, it's starting to break down a little bit, and that's called deferred maintenance. We know that, we calculate it, so we've got an amount every year that we transfer to our budget to cover all of the general repairs across our campus. Well, if you're building all these new buildings, you better be increasing that deferred maintenance reserve to make sure that you're covering the breakdowns and the repairs that are ultimately going to occur on that building. So again, just another way how the impact of capital can have on your everyday operations budget. On the right-hand side, there are maintenance of current activities. Again, these are things that aren't necessarily sexy and generating new revenue. They're not new programs, but they happen. I gave you my boiler example, where we had 4 feet of water in our boiler room. A boiler from 1960 doesn't do well when it's under 4 foot of water. So we got it operating again, but it's got to be replaced to the tune, we're going to be talking almost $2 million for that sort of a repair. You're not going to generate funds for that. You're probably going to have to borrow money for it. No new money from a boiler. That's just standard, your standard operations. And impacts current activities and current. Yeah, a lot of these things, you put the repairs and renovations, or even residence halls. All these things, they're gonna have a direct impact on your current operations. So we've covered it all. We've gone through the whole framework, the whole chart. Just double check where I'm going here. So again, we've tried to help you understand that while that left-hand side of the chart is sort of I'll call it a well-oiled machine, but it's not a machine that spits off a lot of opportunity for investment. We've talked a little bit about the right-hand side and the resources that are available, and we've talked about the expenditures that we might take on to help make ourselves better, stronger, and more competitive. So my last slide here, I do believe, yes. My last slide talks about the trade-offs and interrelationships. So these are sort of I'll call them accounting proverbs. So to increase an operating expense, you need to increase revenue or reduce another operating expense. We call that the zero-sum game. And it's oftentimes when people come in with a great idea to our, we hear them all the time. I've heard lots of great ideas, but the reality is it's got to come at the expense of something else. And it sounds so cruel to say that, but the reality is we all know we balance our budget, and there's not a big old surplus built in there for strategic investment. We count on other mechanisms to do that. So we'll oftentimes say, what's your funding source? If you've got a great idea, what's your funding source? Because, if I take that idea and I put it in my budget, whatever it costs, I've now created a negative number on my bottom line. So, and if everybody spends to their budget, I've created a loss. That's not something we can do. So that's proverb number 1. If operating expenses exceed revenues, investment resources are often decreased. So this is the example where I say, if you come with a great idea and you say, you know what, this is a super idea, it's a one-time expenditure, let's use that excess reserve that we have or a prior year surplus that we realized, it's a one-time funding source, let's use it, let's get it done. Great, but again, our availability of our investment resources has gone down. To increase investment resources available for strategic expenditures, we may need to borrow. We've talked about that. So again, one of the I will say, benchmarks we like to do when we talk about borrowing for new capital projects or buildings, and this doesn't always work, but if you can try and raise at least 50% with a goal of 75% of your fundraising effort to get a project built, it will at least mitigate in some way the operating impact on your budget, because when you build that building and you take on that debt service, it's more than just that. The examples I gave before, it's the cost of operating it and running it. So try to make sure that you account for all those things in your budget. Last one, strategic capital expenditures oftentimes increase operating expenses beyond debt service. I just said that. So the reality is, it's a sort of make sure you are taking a comprehensive look and view at these things as you're contemplating them. So this is the boring part of today. This is kind of what we referred to it last night as the nuts and bolts. I apologize for having to drag you through this, but the reality is, I think as you go back and reflect on, go back to that terminology sheet. Those are some of the things that you've sort of heard me interject throughout this presentation. Those are the things that you'll, I think, need as your sort of toolkit as you go into your case studies and try and solve those problems. So at this point, I would entertain questions about any of the things that I've talked about or about Moravian College. I'm happy to share with you whatever insight or intel I can. Sure.
Yeah, you had your pie chart up here, non-use and operating expense and test standard. You see these expenditures, strategic expenditures, increasing that 9% to be higher because of the ongoing costs. As you put in more of these new programs, all the operating.
No, can you start? I'm sorry, I missed the early part. Here, and use this that way.
Yeah, okay. I'm Tim Foley from Lehigh University. So I have a question about the pie chart you had up at the beginning, about 9%, most of it's staff compensation. Do you see the strategic expenditures happening at Moravian or Lehigh, where I am, building all the buildings? Do you see that changing that somewhere up there? The depreciation in debt services. Do you see that you see that going up from 9% to something, I don't know, like 15% or something like that?
So I can speak to that firsthand because, as I mentioned, we've done a lot of construction and a lot of buildings. So when I started at Moravian, and it's 18 years. I appreciate the 2 extra years of service, but it's 18. You put 2 years more on my life, I'll take those 2 years back. So when I started in 2001, our depreciation expense was $4.5 million. We just eclipsed 10 million. So yes, it has a direct impact on that. And it really has a direct impact on everything else in terms of, because your operating costs increase as well. If I look at when we've opened a building, we opened a building because we had new programs, we had new faculty. So while the number will go up in whole dollars, and there is likely to be some shift in the percentages, I don't expect it will be radical. I mean, if it's happening in that way, I'm not so sure what that would mean. But in our specific example, the two biggest areas that we increased were new academic programs. So those came with new faculty, so the staffing went up. It came with all the maintenance expenses for those buildings, that went up. So, I'm not sure if that answers your question, but it No, it's not. I mean, part of what I'll give you our example. So when oh God, I think Dr. Grigsby was here for not even a year, and he was a member of the 24/7 Fitness Club, which was down at the old Bethlehem Racket Club. And he came into my office one morning and he said, "The doors are locked on the fitness center. Go down and find out what's going on, because I'm interested." So I'm thinking, oh my God. I mean, this is a building that's been in receivership twice. It's in a floodplain. It was just deferred maintenance. You could just smell it when you walked in. But I'm like, all right, we'll check it out. And so we went into this building, and I said, what's your idea? And at the time, as you know, we were investing in the rehabilitation sciences, and he had this idea that this could become, because those are graduate programs, are generally cohort-based. It could be a little bit removed from the main campus without a big strain. So he said, build a business model. So to your point, how do you know? That's part of what, I'm not so sure you'll be able to get into that in a great level of detail in your case studies today, but you're going to have to sketch something out, and that's essentially what you do. You say, okay, you begin to dream and say, here's the programs that we're going to start. Here's when they're going to start. Here's how many students we expect in each cohort. Here's what the tuition we expect to receive. Here's the faculty that are going to be required to support it. And you just start building it. And, you know, for those who are friendly with Excel, it's fun. It's actually, it's a lot of fun. So you build in the purchase of the building, the debt service on the building, and everything. So that's the answer. I think, how do you really know? You build a business model to figure it out. Yes, ma'am. Oh, you know what? Okay, all right.
I think you may be thinking about incorporating the expectation of future interest rate in that model related to debt service. Don't you consider that at all?
I'm sorry I couldn't hear you. Could you? No, I'm just kidding. No,
Interest rate is the cost of borrowing. That has nothing to do with that debt service?
well, it would be yes, it would. So in that pie chart, yes. So principal payments and interest are contemplated in debt service. So in our operating budgets, it's not just the cost of paying the principal back. The interest is in there as well. So at least we do in our business model, and it's certainly captured in those reports. Your 990s, which again is the source of all this information, it captures it all. So everything that you're paying is covered. Now the reality is on the 990, and this is again not to get into too much accounting speak, but the way that new building would be reported in those numbers, the what I'll call the principal or the depreciation is in the depreciation number. The interest payments are probably, well, they're also going to be in debt service, but interest expenses, it's interest and debt and depreciation is the way a new building would be reflected on that pie chart. So yes, it is contemplated. Do you have a question?
Yeah, I wanted you to see if you could talk for a minute about the interplay between finance and the academic side of the house, because this is all heavily business, and if in business, if widget Y isn't selling, we stop making widget Y. But if major Y doesn't have many students, we don't always just cut major Y because it's not that simple.
So I'm going to go out on a limb here and say I think that's part of why we're here today. I think we are part of the goal here is so that we do have a more integrated discussion, so that you have the tools, if you're in academics, to understand and ask the right questions and to be at the table, if you will, as part of those discussions. I'll tell you, as the one who's tasked with creating the business model, I will tell you, when we did the rehabilitation sciences, those program directors were in my office, or I was in their office constantly to help understand it. That's in terms of growth of new programs, but I think the objective here today is make sure that you walk away with a better understanding of what rolls into these things, to ask the right questions, or to know of investment resources that are available to perhaps start a program or start an initiative. I think that's kind of the goal here today. Nope. Trust the microphone.
So it's a question of where does what goes in the boxes go into your chart. So if you build a new building, you've got infrastructure, the electric and all that kind of stuff, and you have appreciation on the actual physical structure. But what about equipment and furniture, and especially if you have, like the rehab sciences, high-tech equipment, where does that fit into the model?
So in the business model, it's essentially a line item. The business model is a little more, I'll say, simplistic. It's more on what I'll call a cash flow basis. So when you're outlining all the equipment that's required for those rooms, whether it's the cadaver lab, for example, those are things that are contemplated as individual line items in a business model to determine whether it's sort of cash flow positive. So a business model is very different than what we're contemplating here. The reality is, as it would hit here, similar to your point, once you actually purchase them, so when we go out and we buy all of that high-tech equipment, we purchase it, it falls into that depreciation number. So it's a little bit of a misnomer, but where things actually fall into sort of this pie chart versus how we evaluate them as whether or not to do that initiative in the first place. So
Work goes down, the equipment is not worth as much, but where do you put in the cost of maintenance or replacement? You know, are those other expenses?
So there's a couple ways to do that. Most business models that we build has a overhead allocation. So overhead allocations are, you can, it's for all of the expenses related to like my time. So when you build a new rehab science program, there's a cost there for me. There's a cost for the president. There's a cost for recruiting the students who are going to go into that building. It's all sort of the general overhead. So most business models you'll build will come up with sort of a gross margin. That's kind of like the tuition that we're charging or collecting, the direct costs of producing that program, and then there'll be an overhead allocation. My suspicion is in most models, those who build these models, things like you're talking about, sort of the ongoing maintenance, deferred maintenance, are going to be picked up in that. And that percentage that you put out there, it's a big number. It's 40%, 45%, depending on the program. So again, some programs are going to be less burdened, or they're going to burden the rest of the institution less, so you can kind of tweak that number a little bit. But for a lot of the general programs, so if you're starting a new traditional undergraduate program, we put a 45% allocation in there for overhead. Because look at your financial statements. So for the CFOs in the room, when you look at resident instruction on your financials, what percentage of your overall expenses are. So resident instruction would be in your business model the direct cost of producing that program. But there's another 45% out there of fundraising, institutional support, admissions, enrollment, all those things that roll into it, and facilities management. So these are great questions. Akbar.
How do you take into consideration the general economic?
Akbar, I like running with the microphone, okay?
So how do you take into account the general economic climate in the way you plan out your expenses? So for example, right now, I know we're all talking about 2026 and what will potentially happen in the post-secondary environment. But the last few weeks, there've been all these conversations about us entering a recession. So how does that fit into the planning process?
So I would say from our perspective, the economic climate affects many things in a business model. But from my perspective, the revenue stream is the most important. Because the reality is if we don't generate the students, then nothing else really matters. So one of the things that I would be cautious of, knowing the demographic cliff that's out there, if we're talking about getting into a risky undergraduate program that's depending on new students above and beyond what we already have. And again, this is, in our world, and I'm speaking just from Moravian College, it is so hard to do because in many cases, students don't declare their major till after their sophomore year. So if you want to talk about starting a new picket, criminal justice program, criminal justice, I have to know that if my current enrollment models are bringing in 550 students and I'm building a business model that is counting on 30 more students, I better be able to go back to my enrollment team and say your goal is now 580 because we're counting on 30 students. And I don't care how you count them. Because you're not going to know when they recruit, half of them are undecided. They might end up in criminal justice. They might have an intent for that, but you don't know. So again, I think there's a real risk out there in terms of the economic climate with the shrinking demographics, students willing to pay less and less for college. As we begin to tack on new programs, I just think it becomes riskier and riskier, and particularly the ones that you can't necessarily identify as such. Some of the programs that we've added, they're easy to count. Occupational therapy. They come for one thing and one thing only. Those are real easy to count. When they're blended in our undergraduate programs, it becomes really, really difficult. So it's an interesting dilemma. because we're at a point where you're right. The economic climate is not the greatest. The environment for undergraduate students is really, really competitive. And we've shown you some statistics that show it's harder and harder to get tuition revenue from those students. So what do we do? What do we do? It's like our traditional core thing that we do is being challenged in a way that's making it harder and harder to keep things going. That's why you're hearing about schools that are sort of sticking their heels in the sand and not thinking outside of the box with different ways of generating revenue or adding programs that you might not have ever considered adding before that might be not liberal arts-ish enough. Schools are doing that. They're doing that. They're starting graduate programs. They're starting programs outside of the traditional core because that left side of the chart there with the traditional undergrad is really becoming a tough market. So, I think, your question was more related to a specific, maybe program, but I think institutions need to be thinking about it on a much more holistic level. How are we going to be addressing? I think that's part of what this whole series has been about. When you talk about the demographic cliff and affordability and contemplating new programs, it all kind of fits together in sort of how we should be thinking. I know, at Moravian, we're trying to do a good job of making sure everybody understands all the components that we're talking about in these series. Part of our jobs is to go back to our campuses and kind of spread the word. For those who aren't, here today, we have a responsibility to try and educate our campus. We've had a meeting at faculty meetings. We've had all staff meetings where, we've jumped on that education of the 2026 cliff and what it means and how we're going to react. So, I think your question's a good one. Amy.
So earlier in the presentation, you spoke to the zero balance, that's okay. Earlier in the presentation, you spoke to the balanced budget, and if we have this new expense or a new program that we want to bring on, we have to give up something else or else we're not balanced. So now that I'm on the academic side of things and kind of bridging between academics and finance, reallocation is a common theme that we try and talk about. One of the things that I'm interested in is how successful our programs and majors are. So how would you approach having that conversation of, if we want to bring something new that would generate more students or even just maintain our student population level, how do you have those tough conversations of cutting a program or addressing the ROI on those smaller programs that we have?
So good night, ladies and gentlemen. Don't forget to tip your waitresses on the way out. So no, it is really important. And it is, the last Ikubo conference I went to, one of the things I went with one charge. I'm like, I am going to talk to people about academic programming and prioritization. And those are really scary words. And they get you in hot water all the time. And the only thing I got out of all of the conversations that I started with folks was, it's a process. It's a process. And if you think you're going to come in and have sort of a seismic change, you're setting yourself up for disappointment. But you got to start somewhere. You've got to start somewhere. And I think the reality is, every good, take advantage of any crisis. And I think that's kind of what I like to think. We're in a crisis mode here. It's happening. So let's take advantage of that and be able to think in ways we haven't thought before. And I think that's a perfect example where if we have the right conversation where this isn't about cutting programs, but perhaps doing things a different way or allocating resources in a different way, that can change the tone of the conversation. So, I mean, the reality is we're all in this together. My approach is to, one of my goals is to try and figure out a way that we can look at these things together. The reality is if it's a process that's driven by finance and accounting, forget about it. It's not going to work. If we're all at the table together to figure out, okay, what's our goal here? Let's evaluate, pick the criteria. We know just because a program doesn't have, 20 majors doesn't mean we shouldn't have it. but maybe there's a different way to do it. We can leverage it. If it's a major that only has 4 majors, maybe there's a way to figure that out to combine it with something else or make it more efficient. So again, efficiency isn't a word we like to use. And we talked last night, the higher ed model is not built around efficiency, but we've certainly got to do our best to manage it. Otherwise, there's going to be fewer of us in the room. That's the reality. So I think that was our last question, correct? Or do we have time for one more?
You probably can take one more and then.
We've got time for one more. All right.
My question is about the discounted rate and how in your budget models you determine, I mean, I know, is it historical that you figure out what students are going to pay your full tuition and what students are going to get a full ride because of financial aid? And how do you get those figures? They got that?
Yep.
Talk about just need blind versus need aware and those.
Yeah. So let me start with the one I know, the question I can answer more easily because I'm in finance. I mentioned before that institutions spend a lot of money in research and analysis about enrollment demographics. So this past year, I got more involved than I ever did before in those discussions. It's crazy. I mean, it's an office I don't want to. I'm glad they do what they do because it scares the daylights out of me in the way they model these things. And you're offering financial aid packages off of modeling, and it's modeled based on historical information. And what's really scary about that is it's historical information. And we just said, the theme of this thing is the world is different. The world is competitive. It doesn't take into account that Elizabethtown just did a tuition reset. What impact might that have? That wasn't real last year. So the answer to your question is there's models that look at historical behaviors and patterns based on their grades, where they live, what high school they went to, male or female, have they visited campus, have they talked to a professor. Like, these are all things you keep track of, and you measure their engagement with, their engagement plus just their demography, and all of that gets put in this big meat grinder and spits out what you should offer for financial aid. Now, I can't speak as much to the need-based versus if anyone wants to take that question on, the reality is, I think the need blind versus, I think the reality is most of our scholarships are kind of merit-based, but if anyone, wants to address that, we're not in that mode right now, so I can't speak that much to it. Anyone want to take the mic? All right, here we go. He raised.
I'm Forrest Stewart from Lafayette. The thing about need blind and need aware is you have to define what need blind is. We like to think of need blind as, well, we're just not going to look at ability to pay in our decision making. And that on the surface, that is sort of what we mean. Or that is sort of what we think we mean. But if you really want to be need blind, what you're asking is, or what you're seeking is, we want to be able to enroll a class at whatever cost it's going to take, and it's not going to negatively affect us. In other words, if we want to enroll an entire class of Pell eligible students, then we want to be able to afford that. And schools can say they're need blind, but if an admission officer happens to look at a home value to decide whether to admit the kid, is that really need blind? So it's altruistic to say need blind, but what we're really asking and wanting to do is afford whatever class we want, and voila. But when you look at if your aid budget is $55 million, institutional aid budget, divide that by 0.045, that'll tell you what you need in endowment to fund it. That's when it really, people start jumping ship at that point.
Forrest? Thank you, Forrest. So you just said a number that I probably should have said a little bit more about in terms of putting it in perspective when we talk about our budgets. 55 million, 40 million. Ask what your financial aid budget is for a year. It's staggering. And then keep in mind, and this may not hold true for all schools, but the lion's share of that is essentially tuition discount. That's not necessarily endowed aid. It's coming as just as a straight reduction of sticker price. So, all right. Knock if you're with me. All right. Thank you very much for your attention. I appreciate it.
Thank you, Mark, and please join me again in thanking Mark for that presentation.